to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Today I'm talking to Manoj Sahare, who has built himself an impressive $12 million property portfolio, but it hasn't been without its trials and tribulations. We have a chat to Manoj about the successes that he's found in property investing and some of the decisions that he's made that weren't necessarily aligned with pure investing, but actually had some personal motivations in it around his family, through to straight out things that he would say are mistakes or suboptimal things that he's done in building that portfolio. We have a chat to him about some of the key strategies for people that are risk adverse, where you can actually find opportunities in deals in non-traditional areas, and he gives some really good advice on making sure that the property is the final part of the journey, whereas the strategy and the clarity needs to come first. He gives us some really good insights with that and answers some questions about what he believes he would like to have known when he started, and even advice for other buyers agents looking to enter the space as well. An awesome interview with Manoj, and I'm sure you're going to get something out of this one, guaranteed. Here's Manoj. Manoj Sahare, thanks for joining me on Geared for Growth.
Hey, thanks, Mike. Really appreciate having me on board.
Oh, absolutely. I think the privilege is all ours, especially when we consider the title of this podcast, and that's really talking about your $12 million property portfolio journey, which puts you in rarefied air. And starting with that, looking back from that portfolio that you've built over the last 25 years, what was the moment that kind of kicked it off for you in terms of, I know this is what I want to do, this is what I want to build?
Yeah, sure. See, coming from most of my background or most of my childhood passed in one-bedroom apartment, right? So when I came to Australia and I was renting a townhouse. When I seen like a townhouse with some of the land and all, it was like a small child in a Disneyland, looking up the properties. So that's get me a little bit of affectionate to the property. What I did was I built another duplex with one of my friend, and with that help, like that duplex cost us with the land and with the building, it was only 400K for each, but the valuation was like 800 plus during that time, which helped me to buy my owner occupied.
Yep.
And soon, very short, I understand how the leverage and equity works. A lot of people still spending after 10, 15 years, 20 years, they are not unaware of what's the power of leverage and how the equity works. But I understand that. And I was not good in shares, so there was no other journey of making money rather than property. But one of the most important lesson, or what most important drive me, was back in 2015 when I read somewhere an article that Central Coast is good to invest. Little I know that 145 suburbs are in Central Coast.
Yes, it's a big area.
It's a very big area, and you never know. The article didn't say where to buy; it just say Central Coast.
Yeah.
I know I can remember that I started my journey on 2015. I ended up buying in 2018. So 3 years of my prime when I was earning a good amount of money, I wasted because I was not aware, and I was not aware of buyer agency or people like this exist in those time, and that's get me more attracted towards property when I did personally go visit Longevity, go visit all the areas, and then decided where to buy.
Yep. I live an hour north of the Central Coast, and even I don't understand it. There's so many suburbs there. There's a fair bit to it.
Yeah, and the important thing is that there are few suburbs, but in suburbs also choosing one suburb is important, and what type of property to choose is also important. So I'll give an example. Like when we brought this property in 2018, we had shortlisted two property. One was 3 bedroom, 2 bathroom, 2 car garage on 500 square meter of land, a very good property, maybe 1.5, 2 kilometers from the beach.
Mm-hmm.
Okay, nicely, nothing needs to be done. It was for 700 720. And this property which we brought was just 400 meters to the beach,
Hmm.
but it was 2 bedroom, very old house. We brought it for 6051, but it was
Yep.
696 square meter of land and R3 zone. So I can build 3 townhouses on that.
Right.
So you need to understand not only the location, but what type of asset you're trying to buy.
Yeah. And I think that's a skill set that you've definitely shown that you have. We talked off air about you making some somewhat unconventional decisions like buying in properties in areas that don't necessarily look attractive at first glance. How do you balance that sort of natural gut instinct with the data when you're making those decisions like that?
Yeah, definitely. See that I will give you an example of two of my properties which I brought, which now if you see any buyer agency or any investors will try to avoid or will try to outtalk you that don't invest in this type of places. For example, the one property which I invested under my self-managed super fund back in 2019 uh, was in a suburb called Tregear. I'm not sure whether you are aware of Sydney's suburbs, but Tregear is like a very low social economy area near Mount Druitt.
Yep.
Okay, means the social economy score is only one if you
Right.
look into our data.
Yep.
Uh, I brought it for 480, right? And when I brought that property, my whole concern was because I'm buying under self-managed super fund, I am not going to look for this property or look into this property for next 15, 20 years. I'm just going to buy something in Sydney and just forget it. 6 years later, the property has given me, like the valuation has come around 800,000.
Hmm.
Okay. Now, if we look that particular suburb and the economics of that particular suburb, for the last 10 years, that suburb has given 7.5% growth
Yep.
as compared to any blue chip, like where I'm living in West Pennant Hills, where the social economic score is 100.
Yep.
And that suburb has only given 6.9% growth for last 10 years.
Right.
So if somebody is telling that avoid low social economy area because it's not going to grow, that's wrong.
Mm.
Of course, this type of area comes with some risk about what type of tenancy you'll get,
Yep.
what type of nightmare it comes. So if you have a risk appetite and if it ticks all the other boxes, and when I know the second airport was coming in Sydney. There will be a line slowly from St. Mary's to go to the second airport,
Hmm.
and my property is just 3 kilometers from the proposed new train station. So I foreseen those things to consider rather than just a small stigma on that particular suburb.
Yeah.
Okay, so
And
that's where we come.
And how has that
I'll
property been for you in terms of, because I suppose some people would say, look, even if it's got a projected higher rate of growth, maybe the headaches with a lower socioeconomic area aren't worth it. I'm interested, how has that been for
Yeah,
you, the ownership journey on that one?
yeah. For last 6 years, we had three tenants over there
Hmm.
over the period, and we had one tenant who uh, who was not, like when he vacated, he kept all the mess over there. So he has not taken or he has not cleaned
Yep.
anything. So it was like a mess, totally mess.
Hmm.
So lot of things came out of his bond to clean the place and everything. It costed me another $700 to clean it,
Yep.
to make it to the rental thing. So that was my cost, which when I had bought this property, I already taken into consideration that it might cost me $1,000 per year
Yep.
just because of the negligence from the tenant. But
Yep.
apart from your regular maintenance, if you know this type of things are going to happen and you do the risk mitigate of what things can go wrong, because you already insured you. I have to make sure that I'm properly insured also at the same time. So
Yep.
if you're insured and if something happens wrong and if you have some buffer, then why not?
Yeah, no, fair enough. And I suppose if you have all the information going in, then it's fine, right? I mean, of course, you might budget $1,000 a year, and tenants can be harder on that if you don't have a proactive property manager. But even if it's $2,000 a year, if we're talking an extra 5%, 0.5% capital growth per year, then that money becomes quite small comparatively, fairly quick, right?
That's 100%. And to be honest, like when my budget was only 480, right back then, where I can find a house with land proportion in Sydney with
Mm.
that particular price.
Yeah.
So my whole intention was just to have in Sydney.
Yep. Yeah. No, that raises a good point. You've got to go a fair way out to be able to purchase at that sort of price. And today it's even harder. I want to
Yeah.
ask you about the buyer's
Mike,
agency. Yeah. Sorry.
sorry, I'll take you one more step back
Yeah.
because
Sure.
there is one more property which I would like to discuss.
Yeah. Sure.
Like a lot of times, you can hear this: "Don't buy off the plan" or "Don't buy townhouse."
Hmm.
Now it's all depend what type of asset you're buying and where you're buying. Means of course, me personally, I'm not going to buy off the market or off the plan property in new area. But what I did is I brought off the plan property, a townhouse in Cannon Hill in Brisbane. Now Cannon Hill is only 7-8 kilometers from Brisbane CBD,
Yep.
so there is already a landlock over there. It's not like a new development can happen. So I brought a townhouse for 500K. Now it's value around 850, and it's giving me rent of 750.
Yep.
So you can also buy off the plan or townhouse, but you need to know the fundamentals, where you're going to buy. Like a townhouse closer to 10 kilometers of the capital cities is a good asset.
Yes.
Uh, but people just go, means I will prefer to buy something like that than buying a 700 square meter of land in regional area.
Mm. Yeah.
So that's the preference, and we know that it will be always rented.
Yes.
People will be always rented over there if you got a good school, if you got a good commuting train station. It will be a good asset.
Yeah, look, I think sometimes people like myself, when we're discussing off the plan, we're typically trying to protect the consumers from the harms that can exist within that world because spruikers typically don't exist in the established market. They work in the new market. And when I'm sort of talking about off the plan, my default is to, a one bedroom apartment in a complex of 400, right? Which you could almost sort of
Yes,
say objectively is a bad investment. I'm sure maybe there have been some examples where it hasn't been, but it'd be hard to pitch that against any other established property. But that's not to say that you can't make money in those different ways. You can make money with development. You can make money buying off the plan. You can make money buying new versus established. You just got to be aware of the risks of transactioning
risk.
in those different ways, right?
Yeah, of the plan which we brought was only 6 townhouses,
Yep.
right? In a boutique area. And we know also that three of the townhouses were already ready. So we had seen how the project was and how it is shaping. And we did a lot of research about what type of what type of rental appreciation is happening, and what's the gap between the house over there as compared to the townhouses. So if the gap is bigger, then you got that extra growth appreciation for the townhouse if the gap between the houses and the townhouses is more than 500,000 or 600K.
Yep. Yeah. I want to ask you about your buyer's agency business. What sort of prompted you to go into that? And I want to ask also about some of the decisions you've made working more on a smaller scale business with closer connections than a scalable sort of large business. What was the sort of decision from the outset that that's what you wanted to do?
Yes. See, when I started my bar agency, at the first year, I was more focused on owner occupied properties, like owner occupied. So I spent a lot of time with the clients, having coffee with them, trying to understand. So I was part of their journey.
Yep.
After 1 year, I concentrate on to investors.
Hmm.
And what I felt in 1 year time that the connection was lost. It was more about transition.
Yes.
So they just want to see the property, we present the property, and there was no connection which I was enjoying during the owner occupied phase. And that's where I decided that I'm not here to just make a number or just to serve the client, but I just want to be, whether it's a handful only, but I just want to be part of their journey to achieve their goal. So even if there are 10 clients or 20 clients, it doesn't really matter. But even if I'm a very household for one person who can call me, who can discuss with me. Now I got so many clients who will just call me and discuss with me random things. They will talk me about movies. They will talk me uh, about politics. They will talk me about their personal things, about what's happening in their career and what are the different business opportunity. So a lot of times, that type of personal affection is what I crave for. And there is no right or wrong answer, right? Everybody got different different things which boost you. And for me, what it boosts is connecting with the people and being a part of them in their journey. So when they are sitting after 5 years or 6 years, or they're sitting now, they will talk about me as I'm part of their family. So
I,
that made me very focused that I will only restrict myself and just be niche with some people, only fewer clients. Though my fees might be higher, but I'll be just be with them to till they achieve what they want to achieve.
I love that. And I mean, even movie tips sort of part of the service there. I'll have to make sure
Yes,
I save your number for movie tips if I'm lost on what to watch on a Friday night.
yeah,
I want to
definitely.
ask you, Manoj, about the hype that we hear about off market versus on market properties. It's one of those things that kind of seems to rattle around as something that people will advertise as a point of difference. If they're a buyer's agent, for example, X percentage of the properties we buy are off market, like that is intrinsically a good or a bad thing. And I don't know, I suppose whether it's on or off market, it can be a good or a bad deal. If it's on market, there's an argument to sort of say, well, there's more eyeballs on the good deals, and off market there isn't. Where do you land on all of that?
See, I built my portfolio of 12 million. Out of that, the second last property was the only property which I brought off market.
Right.
Rest all the properties, even my last purchase was on market. As a buyer agent, I get access to a lot of off market properties.
Yes.
But the last purchase also was on market. So when it's off market, there is only 15% of properties are sold off market.
Yep.
So you're missing out that 85% of potentials of good properties, which can make fit to what you want. For me, off market, whoever is promoting only off market is something like a, a investor who is only selling off the plan because they are selling what they're getting.
Yeah.
So whenever the buyer agent or whoever is selling the off the market properties, they're getting it from the agent because of the relationship, and that's what they are passing it to the client.
Yes.
So they are not taking that extra step of going and trying to research on what is on the market, because that's the hard part, right? To be on the market and get the deal done on the market. So they don't want to do that. And what will happen is that whatever they get from their database off market, whether it's expensive or not expensive, they know they can close the deal, and that's what is presented to the client. So of course, off market is good. We also do off market, but that is a secondary. We always try to look what properties is suitable for a client, and that type of property can be on market or off market. It doesn't really matter.
That's a good point. I suppose there's a parallel between, say, positive and negatively geared. I mean, that's not necessarily a strategy. It's just it's happenstance. It's an after-tax event of where we actually sit from a financial point of view. And I suppose off-market is a way to buy, so is on-market, and it shouldn't be a strategy to only buy off-market. It's like buy good quality assets. If they happen to be off-market, then they happen to be off-market, right?
Yes, definitely. And I made it very clear whenever I have a strategic call, I just want to make sure the expectations are set correctly. So we wanted to buy a good property, not an off-market property. As simple as that.
Yeah. I want to maybe bring up, I'm not sure, you'll tell me whether this is perhaps a painful memory, but we were talking off air a little while ago about your foster property, which I think it's probably fair to say was driven a little bit more by emotions than pure investing analytics. How much are you willing to share about that one, Manoj? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yes, definitely. See, when we brought this foster property, we brought 2018 this longevity property, which was just 400 meters to the beach, right?
Yep.
But not a water view. And I don't know why, like most of the Aussies are driven by these water views or close to the waters, and so we were. So me and wife wanted to have something waterfront, right? And I was earning good. My borrowing capacity was good. So I didn't think about as an investment strategy. It's just about having uh, having a water view property was my fundamentals.
Yep.
And we got the loan 2 million or so, and we ended up buying this property in Foster, which is right on the ocean on the cliff. So I can just have a good water view and everything. And we thought that we will go and enjoy as our family, and it will be all our this and that. And we were happy. And when we brought, the interest rate was only 2%.
Right.
Right. And Mr. RB Governor during that time has mentioned that till 2024, there won't be any rate increase, right? So I just thought that, okay, for next 2-3 years, how much I'm going to pay? So it's not going to pay that much, and I'll be able to manage. And by that, my salary will go up, and everything will be under control. So I rent it out to start with for $800, and it was just like a break even, so it was not costing me a lot of money. Of course, as soon as the interest rates start going up and up and up, my $4,000 installment turned into $12,000 installment within a year.
Yeah.
Right. And during that time, then we started thinking of we put it on Airbnb, and it's still on the Airbnb. But my kids are still in the uni and still in the school, right? So it's not that easy to go and take a holiday over there so often.
Yes.
Now, if I put an investor hat, I think that's a very dumbest move I had done, because it was more on sentiment. It had nothing to do with the investment.
Yes.
I'm still juggling whether I should sell it, and because now I'm a BA and I know what I can make it happen with that 2 million.
Yeah.
I can make sure that in next 10 years that 2 million can become 4 million or 5 million, which will give me a passive income. So yes, but there is still some emotion attached to that property, because whenever we go there, after we take a decision that, okay, well, let's sell it. And if we go after 2 weeks or 3 weeks to that property, then we say, we shouldn't sell it, because it's very hard to find this type of properties. And once you are done it, and this should be your lifelong. But I'm just going backward and forward with the decision, and hopefully maybe next 3-4 months, I might be selling that property or might be not selling that property. It all depends.
I suppose the way to think of it is that we're investing to live our lives, and sometimes we want to live our lives in a way that's not super efficient, right? And it might not be super efficient to growing a portfolio to have an asset like that, but of course you're enjoying it with your family, which is the whole point of this after all. But I suppose the cautionary tale is you can do whatever you like, but it's good to understand, well, that might actually set me back if I'm trying to achieve X, Y, Z, if I've got that asset, rather than, say, using that capacity to buy 3 or 4 lesser value properties that are going to see more growth and be hard, less difficult to hold on to, would you say?
Yeah. And, everybody should have that goal, like what they want to achieve. I think when I brought this property, there was no goal. There was nothing. It was just pure emotion, a waterfront property. We don't know in a year how many days we go over there also. It will be like, first when we brought, we thought that it will be ideal, our family home and all. But still we love that place. It's not that it's a very iconic place. We can see whale watching and we can do all those things. And coming from a background where we can't have this type of luxurious amenities back home, I found that this is a good place. And whether I wanted to make that 2 million to 4 million or 5 million will be my decision, whether it's suitable for me or not.
Well, it's an absolutely stunning part of the world. So if you do put it on the market, let me know so I can sneak in for a bit of Airbnb time first, mate.
Sure, sure.
Leaning into, perhaps areas that you would define as suboptimal or mistakes, or maybe just deviations from what would purely be seen as growing this portfolio. You've shared a couple of things with me off air, and I'm putting you on the spot now, but things like selling too early, the warehouse joint venture that you did. I just wondered if there's any of those that you're willing to share, and what maybe the learnings that you took from them, so we can benefit from that. You pay the price and pick up the tab, and we'll just sort of coast on through on your coattails, Manoj.
Yeah, sure. See, financially, I lost 100K plus in one of the property deal back home.
Mm-hmm.
Okay, but I'm not too fussy or too worried about that because that was my foolishness, right? Where I had invested and given the money to a builder for develop for off the plan property back home.
Yep.
But the most painful lesson, what I can see, was about that particular warehouse which four of our friends, brought in Voyong,
Yep.
with the mindset of, because it was having a zoning for apartment, with the mindset of uh, getting that apartment drawing and apartment approval ready, collaborate with the builder, build the apartments, and then share the profits and all,
Yep.
right? So on the paper, on the surface, that was very elegant project, but we never explore the exit strategy, and we never explore individuals' preference. And what happened was, and again, a lot of time there is no right or wrong answers, right? Or there is no right or wrong person. Everybody's situation changed, and we couldn't move forward, and we sold it. Like, I personally feel that if we could have maneuvered that particular small issue somehow, we could have make lot of money. So uh, my advice to anybody who is going into joint venture with friends or with families or whatever it is, make sure you have an exit plan. Like, if somebody have some issues, and how that exit plan can be executed, I think, which we missed in our journey. I think that's very important, because at the initial, it's a honeymoon period, we all are excited, we want to do everything together and want to achieve that goal. But but things can change in 1 year time. One of the partner might lose a job and he might need some money. Things can do, anything wrong can happen,
Yeah.
and that's where we need to have an exit plan written and drafted, so that you don't commit the mistake.
Yeah, absolutely. I want to ask a question about we talked about the foster property, and you've made decisions not just for the financial return, but of course for your family as well. For example, buying in West Pennant Hills was not necessarily a perfect investment decision. It was also about the school zoning. How do you generally balance financial outcomes with life goals, and how do you sort of advise clients to try and do the same?
Yeah, see, I've seen so many, like, on different forums, people are asking random people, uh, particularly the first home buyers, whether this suburbs is good or that suburb is good.
Hmm.
And everybody will have their own say, because from their perspective, it might be good or it might be bad.
Yep.
And I feel sorry for those people who are asking this type of questions.
Mm.
I think it should be your personal choice. What is your priority? Your priority can be schooling, your priorities can be transportation, your priorities can be brand new house, your priorities can be anything. And that priorities can be always different from individuals to individuals. Now, when I brought a property in West Pennant Hills, my priorities was one and only schooling for my kids.
Yep.
Not only the primary school, but high school. So high school like Carlingford High and Cheltenham Girls, both the schools are, in a high school is a top ranking in a public school. And that was the only reason I moved to the West Pennant Hills. Though my house is like on a slope, it's a 5 bedroom house. It's on a slope. A lot of people might not buy this type of property because it's a battle X. Whereas all the property selling on the road was around 1.1, 1.2 million. I got this for 815 because it was down the slope. But
Yep.
my budget was only that. I can only afford that much. So I was not having a choice. Since I could have easily bought a property in Ponds or K-level. Those areas are also good, but my priority was school. But I could have brought in 800K property in Ponds with a swimming pool, brand new house, nicely thing. But I made a compromise on schooling, and my both the kids are now into selective. My son is doing actuary in UNSW. He got 99.1 ATAR in
Wow.
HSC,
Yeah.
and I feel proud of my decision that because of this location, I can give that education to my kids because their primary school was good. And because their primary school was good, their friend circle was good. Because their friend circle was good, it was like always competition between each other. And most of his friends, like all his close knit friend, has got more than 98.5%. So all they're good. They all are doing engineering or law or medicine. Um, and that was a good decision which I made. Instead of just buying a property with a good facade and uh, good kitchen, good like a massive swimming pool was not my intention.
Yeah. Yep. Yeah, and I suppose there's always that interplay, right, between what would purely be a good investment and what is the needs of you and your family if you have one at that particular time. But there's also ways that you can sort of stack the deck in your favor. Let's say you actually think there's a better location elsewhere for pure growth, but you've made the decision to buy here. You can also buy well, right? And it sounds like you've probably done that in this property as well.
Yes, and you'll be surprised. We just did a valuation, and I brought this property in December 2012,
Mhm.
and we are talking in January. It's 2.9 million.
Wow. Yeah, right.
So the valuation, maybe when I put this on the market, I might not get 2.9 million. It might get 2.6, 2.7, but still,
Mm.
it's like three times what I paid, more than
Yeah,
three times what I paid.
that's pretty good growth. Now, I want
Yes.
to ask a question for the property investors or the would-be property investors that are asking uh, that maybe are listening, I should say, that if they are a little bit risk adverse and they're looking for their first investment property or their next one, they're not necessarily wanting to go too crazy. What sort of conversations do you have with your clients that are really quite nervous going into it? And is there an asset that you think is not a big compromise in terms of what it can do for them that does look a little bit less risky on paper, that gives them that comfort to maybe make the first steps that enable them to set themselves free of their fears later on?
Yeah, sure. And a lot of first investors are like that, right? They're
Mhm.
fearful. Their risk appetite is very low. For those type of people, I think they should prioritize the stability, right? The stability is the most important thing. Uh, predictable returns, predictable returns, and long-term wealth creation. I think that is more important rather than just rapid growth or rapid capital growth. So when I talk about predictable returns, I'm talking about instead of chasing hotspot or boom and bust, they should look for some established suburbs which has given you around 6 to 7% of growth over the period. So don't chase hotspot, don't chase boom and bust things. Make sure that your cash flow is well calculated. You know how much is going to go from your pocket. It's all accounted for. Uh, Put some emergency fund. Also look for something low volatility, like stay away from speculation like mining town, or and have a risk mitigations, right? Like for example, put an insurance in place. Um, uh, put Consider putting your property into trust so that it have an asset protection as well as what do you call estate planning.
Yep.
Like for example, 4 bedroom, 2 bathroom, 2 car garage on 450 square meter of land somewhere in Brisbane's growth corridor, call of like a Deception Bay or Logan somewhere, which is giving a strong rental yield of 4.5%. close to the school, close to the infrastructure, this type of the properties won't go wrong.
Yep.
Even if you get 5 to 6% of growth over the next 8 to 10 years, you're going to make 300, 400K equity straight away on that.
Mm.
So yeah, that will be more safer bet than just buying in something regional. And bear in mind, a lot of my client has made money in regional. It's all about how much risk appetite you have and where you are in your journey.
Yeah, absolutely. I really believe that fitting the property to where you're at in your journey is important, not just going, okay, well, this is the next hotspot or the good place to buy. It's like, do you actually have the capacity to have a negatively geared property with big upside because you've got other cash flow ones, or do you actually need to look at the cash flow to consider serviceability down the track? I want to ask you, with respect to your portfolio, where are you at the moment, and what sort of goals do you have in the next little while?
Yes, see, now I'm still into acquiring mode for next 2 years, two
Yep.
and a half years. Then I'm going to go into consolidation. I just wanted to make sure that a few of the properties I can sell off and get into more passive income. So my target is to have a passive income around 400K
Yep.
per year in next 7 to 8 years.
Yep.
So by 7 to 8 years, my aim goal will be to have 400K passive income.
Yep.
At this stage, it's not about retirement. I'm not going to retire after 7, 8 years. It's all about financial freedom.
Yes.
It's all about now I might be working 6 days a week. I might want to work only 3 days a week in after 3 years or 4 years. And I want to just make sure that I have a second in charge or second in person working with me, which I already identified working with him at this stage. So then we can just make sure that we have this boutique relationship with the clients and have only small number of clients, but give them everything what they want, like a roadmap from one place to other. Uh, Whereas when you talk about the property and finance program, I will go into more consolidation in next 2 3 years time. But I will have at least a couple of more properties acquired in this year and next year.
And it's wonderful to see that you can get to the point of a $12 million portfolio and say, well, I've made mistakes along the way, right? So people could
Yes.
potentially not make those mistakes and maybe get to where you are faster, although you're in rarefied air, even with the goal setting of 400K passive and the 12 million. So I want to finish off by, if someone is inspired by your story, which I assume a few people will be, what's the best piece of advice or something that you wish you could have told yourself at the beginning that might have helped you to get there sooner?
Yeah, I think one piece of advice will be start with clarity. Like
Yep.
everybody needs to have that idea of clarity. It's just not about passion. I heard a lot of people just talk about passion, 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 but it's about clarity. What you want to do. Get extremely clear on your why, your strategy, your timeline. These are the three more important before you make any first move. Like, for
Yep.
example, why it matters, right? Is it because you're just excited, because you're just seeing some wins on social media from some BAs or people some making some properties and making 200K, 300K, or you're just fear of missing out. Like, so my friend has brought a property, or my friend is become a BA, so I should
Yeah.
become a BA,
Yeah. Yeah.
or invest in the property. But property in business is a long game. It's not like when I went into BA business, I given myself 3 years, like 1,000 days. That's what I told to myself, that I will try for 1,000 days. It's not about 1 month or 2 months where you will decide whether you want to do this or not. So me and my wife discussed about this, and I had given 3 years, and 3 years has been completed, and I'm going to continue. So I tick that box. Uh, for BA, I think to become a BA should be clarity on your niche, right? Whether you want to clarity. I've seen lot of BAs uh, get sidetracked. Some BAs are doing owner occupied. There's doing also commercial. They're also doing investors. They're also doing house and land package. So I think you need to get your niche
Yep.
at least at the beginning. Once you grow, then you have different arms that I can understand. But at least to start with, have your niche. Clarity on your value proposition, right? What will make you different than other BA? For us, it's that one-on-one relationship. It's
Mm.
for us, it about hospitality, because I think everybody will going to give you service, but that hospitality will be the one thing which we will give to you.
Yeah.
So try to get your clarity on value proposition, of course, and then the business model, whether you want to work on solo or work with somebody else or as a partner, have that clarity, and clarity on endurance, how your 6 to 12 months you will cope. Are you doing part-time, full-time? So there's a lot of things you need to check in. But for the property investors, like I think again, clarity on the end goals. Acquiring the property is the last piece of the puzzle.
Mm.
First, you need to have a strategy and your goal, what you're going to achieve. But a lot of people just, because my friend has brought a 500K property, I'm just going to go there and buy a 500K property.
Yeah.
Lord, like 80% of the people just do that.
Yeah.
That's it. I think the first, that property buying is the last piece. You need to understand your strategy, your goal, and timeline. The other thing will be the timeline is important because 5 year goal will be totally different from your 20-year goal. So
Yes.
make sure you work with your timeline and clarity on education, right? Uh, you educate yourself, but don't go into risk para- analysis versus analysis and paralysis.
Yep.
Take a calculated action, like any relationship, right? Clarity before commitment saves from from regret. So it's very important that your clarity is there.
Yeah, look, I love that, and the way that you describe property as being the last piece, I think is powerful because, as you say, 80% of people typically it's like I'm buying it because this person said, or I don't want to miss out. But the strategy is something that they try and backfill, which they should ideally be clear on at the beginning. A lot to unpack from that, and there's a lot of insights from you, Manoj, that I'm sure people will take a lot away from. Thank you very much for sharing all of that with us today.
And thanks, Mike. My pleasure. Thanks for having me on.
That was good fun. Thank you.